This is a summary of economic outlook and trends for 2023. One of the key takeaways was it's better to be roughly right and take action than to be precisely wrong and wait too long in terms of doing what you're doing. One of the first things we talked about was this theme of several different things happening right now. First off, in 2023, we're going to continue to have the Fed tamping down on inflation and economic uncertainty. That's going to continue to keep interest rates high. Economists are split. Some economists believe that by the end of 2023 that we will have a slowing economy and that the Fed will not only pause, but they will start to lower rates. A greater majority of economists believe they will not, and that for the entirety of 2023. Unless there's some outside event that occurs, they will hold rates high in the current range around 5%. In terms of other things impacting the economy, the Ukraine-Russia war, to the degree it continues to be a long war, is going to be a drag on the economy with the issues of inflation. Energy will continue to be an issue, particularly the non-storability of long-term reserves. The fact that oil, we have reserves only for weeks or months unless it's in the ground and it can be accessed. Renewables work when you have water for dams or you have sunlight for solar, but they all have their limitations, and presently renewables are only about 13% of the total energy flow, so there's much to be done there. The other thing we talked about is slowing growth. You could have a possibility of stagflation. That's where you have inflation plus you have no growth, or you're in recessionary times. But whether we reach the official demarcation of a recession or we just have slow recession in terms of growth, it is slower. You can see this through the many layoffs and things that are happening. Wages are sticky. It's difficult to get those down. The way they go down is through layoffs. It's very difficult when you give higher wages to take them away. So typically you'll have automation or other things that will lower wages as a proportion of overall expense, but actually lowering wages is very challenging at this time. Supply chain disruptions are minimizing, but they continue to occur. What you see is the unwinding of the globalization and people putting their supply stocks in stores closer to where they are, and in some cases buying up the food chain to make sure that they get the supply they need. Number 7 is an area that we spent some time on. That's talking about rapid acceleration of technology modernity. This has the possibility of reducing some of your need for labor because of what you could do through your factory process automation and other work. We talked about the rise of China and the Asian roaring economies. These are important because those are the economies that are currently growing fastest and hold the hope of keeping the world from going into a longer-term recession. We also mentioned the cryptocurrency bubble and the survival of the fittest. It's likely that the technologies will remain, but most of the players will not, that there'll be new players in this field. And of course, there's this notion that regardless of where we are, you could view it either as a bull or a bear case, and there's information in the presentation that could cause us to think about these various trends. If we look at what the current forecasts are, the Financial Times recently put out an overview that everyone seems to agree that the global GDP growth will keep slowing and that inflation will crest but remain sticky. Central banks will keep tightening, albeit not so quickly. The Fed-induced recession will tame the U.S. consumer spending binge, but household, corporate, and bank balance sheets will remain generally healthy. When we look at where the growth is coming from this next year, we see the following. This chart here from Goldman Research. We see that China, their projection of growth is high, that Asia, excepting Japan, is also high. You'll notice that Japan is down here a little bit lower and is not expected to increase, but to contract. So that's where we're looking at growth generally in the future. Another thing to look at right now is the unsettled nature in terms of bonds. We're looking at bonds that are basically government bonds and with some promise to repay. And the bond markets are the most scared now that they've been in many years because of uncertainties that are happening in the economy. And that tells you a little bit about the conundrum that's there right now. Not only are we dealing with our own economies, but we're dealing with great changes in the overall marketplace, particularly in the broader economy and in governments. When we look at where the Fed is likely to go in terms of interest rates and your forecast for this next year, Goldman Sachs has put this together. The current forecast is to continue to run forward through this next year with some type of leveling off in the 5% range, and then at that range to hold for a period of time until such time they feel that they can lower that without causing a greater increase in the inflationary conditions that exist. When we look at market conditions generally, these were the conditions. The CPI was 7.1%, still elevated. GDP was positive at 2.9%, so that was growing. However, I mentioned in the presentation that much of that growth stemmed from the military spending that occurred to support the war, as well as increased spending from the government of things they could do to juice the economy prior to the election. The unemployment rate at that time was 3.7%. As we look at other data, this is a picture here of the current level of the balance sheet of the Fed. And they are now just starting to pull back. But if they pull back all the way to trend, that's a lot of capital coming out of the market. It's unlikely that they will pull all the way back, but it is something to consider. We also had this comment about the GDP. We had 2 negative quarters of growth in 2022. Typically, that would be the sign of being called for recession, but they determined that it was nominal and minimal and that they would push forward until it was something more significant. Whether you're a purist and you say that it was or not, the institution that actually declares whether there's a recession or not is the one that has determined there was not one starting yet. One of the charts that I encourage people to look at is this chart. It's the weekly economic index. And what you'll notice that had you been looking at this from this last year, that the weekly economic index has been trending down. You'll understand when this starts to average out and come back in a positive direction that the trend of the economy will move forward. A couple other things that are important to note is that retail sales still continue to grow, although they start to flatten. There are certain industries that are more impacted. You can see here that construction is more impacted on the residential side, largely related to rates of interest. When we look here at consumer confidence, this is a very interesting chart to look at. And this shows the blue one is the conference board, and they are looking more broadly at attitudes of the consumers, particularly in the industries where they are. Whereas the Michigan survey is more what I'll call mom and pop on the street level. And so what you might take from this is that those that are doing well more financially are doing well, but they're seeing some softening. But at the street level, there's much more pain on the street, and that is actually a very negative reading in terms of what's happening there. We walked through several other charts. One of the ones here that I like to put out, this is the Purchasing Manufacturers Index, and you'll notice it looks like a ski slope. So we have not reached the point where companies are starting to order more, but they're actually ordering less. And this is what's behind the layoffs that you're seeing in companies right now. They don't have the orders to continue to provide the employment. So rather than hold people, they are laying people off. Now, why this is interesting, here's a chart from Charlie Biel, somebody that I follow. I think he's very knowledgeable in this area. You'll notice that whenever the ISM Purchasing Manufacturers Index drops below, that we've had other recessions, and so it would not be surprising in this level to see a recession called at some point. We have a conundrum in terms of labor. If I showed one chart that I thought it was important for you to look at, it would be this one. And what this shows is the red line is the potential civilian participation rate. And what's interesting here is that you notice the rate is going down. And what that means is that there are more people coming out of the job market than are going into the job market. Therefore, as we reach headroom on basically run into that red line, we're finding that we're starting to overpay for services. So several things should come to mind. One, there are not new employees out there to find for the new jobs without increasing pay. And when you think about that, because you're going to be stealing people from one place to another. The other part is this is a mandate to do all you can to reduce the labor inputs to what you have in order to try to drive costs out of your system. One of the things that chart shows is anticipated population that would gradually leave the workforce left more quickly and have not come back. So it leaves us with this issue of where to find more people. And I've got 10 ways for us to find more people. We can do stealaways, and that means we'll have to hire more. We need to get really good at doing that. We can hire employees that are seeking refuge from turbulent bosses at companies. We can hire graduates from colleges and universities. I've not highlighted that one here because I think that's something a lot of people have been doing. Number 4, we could consider rural insourcing, seeking to engage people geographically in areas that are not close to them where you've learned how you could do remote work. You could do an acquire hire where you buy businesses where they have assembled teams where you can't hire an individual. You might be able to hire away a team. You might be able to go after retirees and get them to come back. My suggestion here, get several to come back and have each of them do part-time work so that they get the lifestyle they want as a retiree. You don't increase your health care costs, and you get the capable talent to come and help you. You could have young persons who have not returned to the workforce. You could get veterans to come and help you. You could find the reformers. You could try to access labor that is either in halfway houses or minimum security prisons to work on projects that you can do. This is particularly helpful for assembly, construction, other types of jobs. And lastly, you can break jobs down to the jobs need to be done, something like Clayton Christensen would talk about, breaking those into the jobs, what are the particular activities, and when you do that, frequently you can find labor that can do those types of jobs, breaking it down to its simple parts, and that could be a way of accessing more employment. So those are 10 ways to try to find more people that one might hire. Now, one of the things that we did talk about was this notion that job switchers are making a lot more money. And this is a real problem right now, in that people are going out and finding other jobs. The jobs pay more, and we need to do something to keep the people employed that we currently have. So I encourage you to think about what you could do to pay your people more money. I did put together a deck of 9 ways to pay your people more money. I showed a couple of those during the presentation, and I'll provide that to you in summary here as well. The other thing we looked at was about the types of employment areas and where the jobs were in demand, that anytime you're above this 45-degree line, you're going to find that you're having to pay more for services than you've done in the past because of the demand. You'll notice that arts and entertainment are much higher up, and you can see in this chart they have actually escalated greatly. We see here an example of wages that were increased last year, and we talked about how some companies have the ability to pay higher wages because of their average income per employee. And so that's something you want to think about. How could you increase your own average income per employee? As we walk down through the trends, knowing that we have this issue of how do we pay more, I think it's really important that you think for 2023 on how do you accelerate the level of automation in your own industry. And so you can see here from a chart from McKinsey how automation is starting to impact different places. You can see how from this chart how computing has rapidly increased. I used to think that we were right around that area where the AI has a mouse brain. I'm now convinced that AI is much smarter. And I shared an example of where using even OpenAI is now allowing us to use other resources. And so here I introduce my latest assistant. Her name is Amelia Chatterley, and she's not a real person, but she is real enough for me. And she's an amalgam of a variety of different AI solutions that are available, particularly an example using the Chat GPT. It is possible to make money in all markets, up markets and down markets. It's just that when the market is going up, we make more money, as this chart shows. As we're thinking about where it is that we want to operate, if you can find in an inflationary environment customers in these areas, you'll find you'll do better. If you can find people who have needs in this area, they still tend to pay their bills. And both of those, I think, are really important components. When we think about where the market's going, we definitely have risks of many different types that are out there. And so I just want you to be aware of a couple of things. Even if we go into a recession, recessions don't last forever. Average recessions last 8 to 14 months, so be prepared for that. Some have compared our current time to times of the past and have said that if we compare what one crash looks like to another, when do they occur and how they occur? For me, I think today looks most similar to the 2000 time and the dot-com bomb crash, where basically the market peaked at a given point and it came up and down and fought mightily, but over time, recession was finally mounted, and then our enemies tried to kick us while we're down. I could imagine that we could have a similar type situation today, and one of the core things to remember here is this whole notion of dead cat bounces. Yes, there is money to be made peak to trough on each of these bounces, but until the market finishes wherever it's going to go and starts heading back, it can actually be a very painful time for one to be in a market. Those things that tend to hold up best during inflationary times, energy, copper, commodities, and so on, are things that are historically important. And I pointed out to the group that a trend that has just recently been happening is one where money is becoming out of real estate and the trusts and going heavily into gold. So I'm not a gold bug, but it's certainly something to think about. We shared in the presentation some insights from Sequoia Capital and some of the things they thought that ones should do in terms of getting prepared for the future. We also talked about ways that we could prepare ourselves. One way would be to figure out how to pay our people higher wages, and so I have that for you online. I've got other strategies that can help you do work. I would encourage you to find out the business measures that help you most understand what success is in your market. And then I would also encourage you to think about what to take into a recession. If we do go into a recession, here are 10 things that I would take. I would figure out how to have 18 to 14 months of cash, something available to operate. That's about how long they last. I'd make sure I had the navigation tools that I could precisely understand what was coming in, what was going out. I'd make sure I have a very agile and talented team to help me. I'd want to make sure that the product or service I'm selling is vital, like life, air, blood, water, something that's vital for others. And if you don't have that, be leaning into what could I do that would be more important for others. You want to go through your own lean management exercises. You want to safeguard your assets since people want to take them, get your resilient systems, and you want to gather around you people who are wise, who have discernment. And I'd encourage you to think about abundance at this time, not a scarcity mindset of every little piece of yours is a little less than mine, but what could you do to help other people thrive? How can you get deeper into their business and help their customer's customer? And lastly, I'd encourage you to have your own group of trusted advisors, because in that you can have the greatest hope of having success in the future. So to end where we began, the Russia war is a current drag on the economy, and at such point that it ends, it will be a coiled spring up, but it doesn't look like it's going to end anytime soon. The Federal Reserve is doing drawdown, both the purchases of assets as well as quantitative tightening. The economic recovery is being noted. The chip makers will lead the way in time, but you're seeing distributed chip building, and I think that we'll have a glut of chips in another couple of years as the factories are put online. Inflation will linger longer. China has the potential to grow and surge, to become the hegemon that statistically they're likely to do given basic trends. The free agent economy will continue. There'll be temporary supply congestion, but those should improve. Crypto itself, the technology will flourish, but the companies and their currencies, many will fail, but they will be harvested by the larger banks and institutions. Cybersecurity risk continue to increase, ransomware, business disruption, and so on, still an issue. I see automation as one of the greatest ways to help our economy right now to overcome some of these issues. We have an aging population that's leaving the workforce, and at some point the government will realize they don't have money to pay for all the retirees who are leaving, so that creates another budget crisis of the future. Climate change is a fact. What we do about it is a policy issue, and so ESG currently is strengthening in some markets, but it's a debate and a question that will impact markets for some time. Political risk, division, and insurrection risk remain. And on this morning, as I'm recording this, I'm thinking about what's not happening right now at U.S. Congress. If you think it's wackadoodle right now, the fact that they are not able to appoint a Speaker of the House And just think of what it's going to be like when they get to the budget impasses of the future, where they need to raise the budget to pay interest payments and other things, and understand that it might be a risk for you and your company, particularly if they go to continuing resolution and you are dependent on government resources. So I would have cash, and I would make sure that you have the ability to overcome any of that economic instability. Economic disparity is widening. There's an increasing conflict of war around the globe in different areas, and we're likely to have yet unknown unknowns. But in this map here, there's tremendous opportunity. You can grow your company through services. You can grow through focusing on how to solve some of the cyber problems. You can grow through harvesting the AI and business process. You can grow by learning how to tap into the free agent economy. There's just so much opportunity here that we have the opportunity to look at the glass half full or half empty. But with this opportunity, I think there is a tremendous amount. This could be one of the best years ever for you if you're courageous, move forward, and with curiosity, figure out how to thrive in this environment. And with that, I conclude this wrap up of the session that we have on economic outlook and trends, the international political economy perspective on geopolitical risk, flaring inflation, growth, opportunity amid commotion.